Hello everyone, this episode marks the beginning of a new segment on my channel, Market Recaps with Cambridgestocks. In this episode, we're going to discuss what in my opinion is one of the main reasons for the market rally that we have observed in August and its subsequent downturn in early September. For those not familiar with the matter, here's a chart of Nasdaq. From various news sources, an average investor would simply assume that the reason for the market downturn in early September are the two prevailing risks that we have in the markets currently: the uncertainty to do with the US election and the second wave of the coronavirus. However, many investors may have overlooked the gamma squeeze that happened at the end of August and early September. So let's jump straight into what a gamma squeeze is. And we're gonna start with a small recap of how we price options and what components can we change. Options are priced using 5 inputs: their underlying, the strike price, time to expiration, implied volatility, and interest rates. While 4 of these components we can keep the same when we're looking at options. Let's say we're looking at 2 different companies, but they're trading at the same price, and we're looking at the same strike price, and the time to expiration is the same. The thing that differs in the price of the option and that makes the options price differently is the implied volatility. Think about it this way: the more people come to buy the same option, the higher the price for that option will be. While all the other components stay the same, the implied volatility is the only component can change. So we increase the implied volatility in order to price the option higher, or we decrease it in order to price the option lower. While we have observed a massive increase in the demand for call options, someone has to take the other side of the trade. And that someone is usually an entity or a collection of entities called market makers. Market makers take the opposite risk that the investor takes. Let's say if you buy call options for Tesla expiring in a month at a strike price of 500, you're betting on the fact that Tesla stock will be higher than 500 by the end of the month. Well, the market maker doesn't want that to happen. However, market makers delta hedge their positions, and they don't really care where the stock will go during that period of time after they have sold you the option because of the delta hedge. I'll leave a link to delta hedging below. So the higher the demand for options, the higher the implied volatility. The higher the implied volatility, the more these market makers have to hedge their positions. Thus, it becomes more expensive for them to delta hedge their positions, aka to buy the underlying shares if they have sold the option. The more of the underlying shares that the market makers buy, the higher the stock goes, simply because there is more demand for the stock. However, this is not in line with the fundamentals. If you build a fundamental model, you're not going to take into account a higher demand for stock options on that stock, are you? No, because it's not a part of a DCF model. I think it is important for the investor to understand the difference between the fundamentals and something like the gamma squeeze and what actually drives the markets. Of course, the 2 risks of the election and the time leading up to the election and its uncertainty and the coronavirus risk are prevailing in the markets. So how do you go about it? How do you go to structure your portfolio? Well, what I think is, in my opinion, extremely important to do with your portfolio is to currently, in the current conditions that we have in the economy and in the current market conditions, is to have a high quality core. By having a high quality core in your portfolio, you have companies with consistent profits, low debt, and other factors which define a high quality stock. By having a high quality core in your portfolio, you can thereby allocate the rest of your money into these tech companies or gain returns or seek to gain returns elsewhere. If you seek to gain returns in just these tech companies, which are extremely popular in Robinhood, you're gonna get slammed by a gamma squeeze, perhaps in the future once again, or by another factor that you may have overlooked. These companies go up in value without the fundamentals really changing. So why would you want to be in those companies? Why do you want to jump on this trend if you're not investing 100% of your time, 100% of your energy, and if you haven't done so before you started investing? So I think it is extremely important to have a high quality core as a center of your portfolio before you start off leaving in the ways of buying call options, buying put options, or perhaps selling options. I hope this short video has taught you just a little bit more about the markets, so that next time you trade, you can take a more informed decision. And I hope to see you guys at the next episode of the Market Recaps with Cambridgestocks.